right. We're going to invite in our first guest right now, and that is former White House chief economist who thinks that Fed policy is comfortably on hold post the jobs report. Joe Lavorgna is now the chief economist at SMBC Nikko Securities. Joe, it's always good to see you. In reading my notes in prep for this conversation, I was curious about something that you point out, and that is not to wonk out on these employment numbers, but why not? There's a household survey and there's an establishment survey. And the establishment survey showed jobs growth. The household survey did not. Explain it and explain what it means.
Sure. The establishment data, Tyler, good to see you, is basically, it's a function of the companies, the BLS, Bureau of Labor Statistics surveys, who is on their payroll, who gets paid at least for 1 hour worth of work during the employment survey period. The household survey is literally governments knocking on somebody's door, giving them a phone call, and asking them if they're part of the labor market. And if they are, they go through a series of questions. So literally, it's the household. You go to somebody's household and you ask them about their employment status. The reason the household survey might be better is that at economic inflection points, because the sample changes every month, it might pick up trends in the data before the payroll survey does, because that survey is based earlier in the year on a set of economic conditions that maybe perhaps changed. Because the establishment survey has a lot more data and it's perceived generally to be better in the sense that you're getting perhaps less bias in it from the people who are responding to the survey, that makes the Fed and others put more weight on the payroll data. Having said all of that, I do think the household data is interesting. Labor force participation is declining. Unemployment is rising. And if it continues to rise, that will be a more ominous sign for the economy next year. But at the moment, as Tim said, roughly $250 a month on jobs, the economy looks good.
So household survey remains weak. Employment was down 424,000 in May and has declined in 6 of the last 9 months. Is that kind of number sufficient to get the Fed to move to loosen up on rates?
No, not yet, Tyler. The core PC, which is what the Fed focuses on, the 3-month rate of change is running up around 3.5%. The year-to-date change is about 4%. I heard Steve's comment about what Rick Reeder was saying about lowering mortgage rates, which will help. The Fed is focused on other metrics as well, such as the supercore, which is core services ex housing. That's over 50% of the core PCE, and that's been running around 4%, and there's no housing there. So it's going to be very difficult for the Fed to cut rates in this sort of environment. Question is, why is the economy healthy? And I think part of that isn't really health as much as it is debt-fueled spending. We have budget deficits that are 5 to 6% of GDP, with unemployment at roughly 4%. That's never happened before.
So let's talk a little bit about the inflation numbers and how you think they are trending. Are they trending lower, and what causes them to get to the Fed's target of 2%? And back to the question I asked Tim: do you have to have a recession to get there?
Tyler, it's been we were saying that this was a supply-driven inflation shock, and then inflation would come down despite all this government spending. And that was the case for about 18 months. And then all of a sudden in January, the inflation trend turned for reasons that are not clear to me, and I think many others. And what that means is the Fed has to take a much more cautious approach. I agree with what Tim said. The Fed will have at most, I think, 1 rate cut, and that'll happen after the election. The Fed needs at least 3, if not 4, good months of inflation data to offset what we've seen. I do expect inflation to moderate because I do think the economy will weaken. I do see some cracks. But right now, the inflation, if it comes down, will be much more gradual than what I had expected, and certainly not enough to get the Fed to ease anytime soon.
Comes back to the point you made, Tim, which is time may be the weapon here. But go ahead. You want a quick question.
And Joe, how about the mosaic this week of global central banks? What does that mean to you in terms of, it doesn't necessarily have to mean anything. And I know you're an economist. You're not necessarily a trader. But you know, you do have a dynamic where you've got central banks around the world, you know, pushing on the ease, albeit, you know, talking out of the other side of their mouth. Any thoughts? It's an interesting week when you get this payroll number.
It's an interesting week, Tim. I mean, and some of the European inflation data and the UK economy, and certainly energy has been a big factor. And inflation there has come down a bit faster than where it has here. And I think that policymakers sort of taking their cue from the Fed late last year wanted to get at least 1 rate cut in. But I don't think they're going to be able to cut much more. It's unlikely that these other central banks can continue to ease rates with the Fed on hold. And I think actually they'll, at this point, probably focus on more what the Fed does from here than the other way around.